what is one thing that you think we should be paying attention to when it comes to the next potential banking crisis?
Here's the most important thing that I think should be on the agenda and isn't high enough, and that's deposit insurance reform.
So tell us, have you been on TikTok a lot lately?
I've been on a little bit more lately. I was a big user during kind of the lockdown pandemic era, as I think a lot of people were.
Yep.
I went a little cold turkey because, as we've discussed previously, I'm trying to get better sleep, have better habits about going to bed, a little less screen time before going to bed. But in anticipation of what might be a ban on TikTok in the U.S., I think I've been upping my intake lately just to sort of get it in before the end.
So your New Year's resolution to get more sleep isn't going so well.
It's going okay overall.
Okay.
I'm starting a little bit sooner. But before we get into what's going on with TikTok and Washington, I want to talk about other stuff going on in Washington. And one thing that, as we prepare for a new presidential administration, will be a huge interest in bank regulation. That's going to be a big topic. I know that's
Definitely.
getting away a little bit from social media, but we've got a great guest today. We're talking with Meg Tahyar. She is a top lawyer at Davis Polk and is super steeped in the world of bank regulation. So we're going to have a conversation with her about what to expect on that front in the years ahead.
I'm excited for that one.
But before we get into that conversation, I want to introduce myself. I'm Telis Demos. I write for the Wall Street Journal's Heard on the Street column.
And I'm Gunjan Banerji, lead writer for Live Markets here at the Wall Street Journal. And this is WSJ's Take on the Week, a weekly show about markets and investing.
Each week, we're bringing you conversations with insiders around the markets and from the inside of the Wall Street Journal's newsroom. We're going to be talking about finance, business, economics, all that great stuff.
And tell us, we have so much to talk about this week. I cannot stop reading about these horrific Los Angeles wildfires. I know you've been all over the story. What's going on there, especially on the insurance side?
Yeah, it's this the situation, the human toll is really bringing a focus to what's been going on in the insurance market. Already coming into this, the California insurance market was arguably in crisis. Insurers have been leaving the state for homeowners insurance because of past wildfires and the difficulty with modeling future losses from wildfires and challenges in figuring out how to price that stuff and work within the state's regulatory framework to do so. This situation isn't going to make that any easier, and I think there's a ton of focus on if the losses from those fires start to get into. We've already seen projections for losses just creep higher day by day. You started with, something, could it be 10 billion? Could it be 15? Could it be 20, 25 plus? We're talking about insurance losses for the market. Those are going to be big numbers that the insurance industry is going to have to figure out. Can we continue to price this risk? And I know, nobody's crying for insurers. They're big businesses. However, that might have an impact, like you said, on people's ability to afford their homes if insurance is really expensive.
You've written about this just over the past week, where it doesn't seem like there's a lot of concern about insurers' ability to make good on those payments. In fact, this could help their pricing power in some way.
Yeah, a lot of times what you see in disaster situations is that insurance stocks are hit initially as people sort of wonder what the losses are, and then, but over time, start to gain because they think about the pricing power that insurers might gain after a disaster.
And that's what's happening right now.
And that's well, I don't know if we've started to see that upswing yet. I think we're still in the zone where we're not sure what's happening. But I want to also highlight what's coming up, which is on Monday, January 20th, we're going to have Donald Trump's inauguration for his second term as president. And there is so much anticipation and so many questions about where the economy and policy are headed. Gunjan, what is top of mind for Wall Street as Donald Trump finally actually takes office again?
It really feels like Wall Street and Washington have never been quite this enmeshed. Wall Street CEOs have been bending the knee to Trump over the past few weeks since his election. They've been flying their private jets to Mar-a-Lago to meet with him. Some companies have been saying, hey, we're shedding our diversity policies. They're all rolling back on some of their prior policies.
Well, I think the industry that's most maybe interesting as we go into this transition is technology. And, we talked a little bit about TikTok at the beginning. Donald Trump has kind of taken on the cause of maybe trying to save TikTok from its potential ban in the U.S. And the Wall Street Journal and others have reported that the CEO, the U.S. CEO of TikTok, will be at the inauguration. I'm not sure exactly what that indicates as far as TikTok's future may be. And I want to say we're recording this before any potential ban would go into effect. So it's unclear what the resolution of that will be. But Republicans and technology have had a strange relationship these last couple of years. Do you think that's going to be something that's really in focus, not just the fate of TikTok, but then what that means for Meta and Alphabet and other big tech companies?
It is going to be fully on display at the inauguration. Mark Zuckerberg, Jeff Bezos, Elon Musk are all expected to attend. And I think Wall Street is watching who else is going to show up, right? Who's showing up at these parties throughout the weekend? The inauguration balls, the host of events that happen around this event. And I think that's going to be key to watch because President Trump's policies could really reshape many industries. Which countries he puts tariffs on is going to be
should
really important to
investors,
see.
though, be thinking about, the stock market this week, next week? What about just from a broader stock market point of view?
What policies the next administration puts on are going to impact many companies, many industries. I think stock market investors, if you are an S&P 500 index investor, it has not benefited you to pay attention to who is president at any given moment. But Telis, as you've written about, it could impact specific sectors, right? Take the banks.
Yes. I think we're already seeing what people are hoping for out of what at least Wall Street is hoping for out of a Trump administration, which is more deal-making activity fueled by things like a touch on regulation for not just banks, but for other companies, and also a more permissive attitude towards mergers and acquisitions, which benefits banks in two ways. One, letting them merge, but also they can participate in more of those deals as advisors and make a lot of fees. And so we saw this past week, a bunch of the biggest banks reported their earnings, and we saw really gangbusters results from the Wall Street side of those businesses already. So I don't know, maybe you want to credit Joe Biden for some of that, but I think some of that is also coming from people trading and companies kind of boardrooms getting active. And so, you saw really strong results for, the Wall Street side of banks and as well as for investment banks like Goldman Sachs and Morgan Stanley.
So people are already gearing up. They're getting excited. They're thinking lower regulations are coming and they're gearing up for that.
But I also want to call out that this coming week, what we're going to see are earnings reports from a different flavor of banks, and that is banks that are really U.S. lenders to businesses and consumers, a lot of credit card companies, Capital One, Discover Financial, and then regional banks like Fifth Third, KeyCorp. And so I think those actual real lender, traditional banking businesses that aren't as steeped in the Wall Street kind of deal-making boardroom side of things, it's going to be really interesting to see how their results go and what they say about what they expect for the year ahead. And already we have not heard optimistic talk from banks about loan growth coming this year, and that's an indicator that if there is economic enthusiasm, it's not necessarily translating yet into that real kind of core banking activity.
Meg Tahyar, who is the head of the financial institutions group at law firm Davis Polk, is going to be fantastic to dive into all of this with.
Meg and Davis Polk have represented a lot of big banks, including J.P. Morgan Chase, Bank of America, Morgan Stanley, and also a lot of smaller regional banks as well. So it's going to be a very interesting conversation about what the expectations are for banks in Washington this year and in years ahead.
We are going to take a quick break, and when we come back, we'll have our conversation with Meg. We're joined now by Meg Tahyar, head of the Financial Institutions Group at the law firm Davis Polk. Meg, thank you so much for joining us today.
It's a pleasure to be here with you.
So I wanted to set the stage a little bit to come into a conversation about bank regulation and financial regulation more broadly. But during the Biden administration, there was a few things happened in banking, one of which was something that in the industry is known as the Basel III Endgame proposal, which was a package of bank capital rules that was meant to essentially finish up the process that really started back after the 2008 financial crisis. A long story short, it proposed what was essentially a significant capital increase on some of the largest banks, particularly some of the largest kind of global Wall Street banks, your JP Morgan Chases and Bank of Americas and Citigroups and Goldman Sachses and stuff.
And it also was $100 billion and up, so it wasn't just the G-SIBs, right? It went relatively down into regional banks. Wasn't capital neutral.
In the first Trump administration, the mandate was sort of you can make changes to bank regulation, but keep basically their capital levels are okay where they are, right?
That's capital neutral.
That's capital neutral.
Okay.
Right.
That's capital neutral.
In the Biden administration, it seemed like that kind of went out the window a little bit, and there was this push for banks to have higher capital requirements, which I just want to briefly explain, and maybe you have a better analogy for this, but basically banks need a cushion of equity that is like kind of shareholders' money that is at risk before it touches like banks' deposits and things like that. That's the capital that banks have to people debate about whether they hold it or not. But essentially, like banks need to keep more need to raise more money in order to do their business.
Banks are highly leveraged. They're more highly leveraged than a tech company or a manufacturing company.
Meaning they borrow a lot.
They borrow a lot.
Deposits.
In the form of deposits, and we have a fractional reserve system.
The reason generally that banks, that it's sort of, it's not ideal for a bank to have more capital from its own point of view is that means that it essentially like they need to have more stock to do their business, which means that the earnings they make are spread over a larger sort of pile of stock. So it reduces the profitability per share, the return on equity. And so it basically makes the bank less profitable by some measures.
It also makes it harder for the bank to make loans, right? Because assets on the asset side of the balance sheet are risk weighted. So if in a growing economy, we want banks to make loan, if we're now going through this period of reshoring and manufacturing, if we want banks to be making loans into companies for what we're trying to do next in the economy, higher capital is correlated to fewer loans. Also, higher liquidity requirements is correlated to fewer loans. But we have to worry about bank safety and soundness in bank runs. So that calibration has a lot of trade-offs, a lot of stakeholders, and is super important. I think one of the changes that we're anticipating in 2025 is a lot more bank mergers, particularly in the regional bank space.
And that might be pretty good for bank stocks because, investors like to, when a company gets bought, that, usually is above their trading price. And so that might be one reason that bank stocks have done pretty well lately. They've had an initial
There's definitely a
Trump bump.
Yeah, there's a Trump bump. There's a Trump trade going in on banking stocks. I think changes.
It's cooled off a little bit, but
it's cooled off. Look, I find it impossible to follow the stock market, on a day by day or even a week by week basis.
So I have a question. As someone who chats with investors on the phone all day, a lot of them are really excited about banks right now. Bank stocks, they've had this Trump bump. But I've been trying to wrap my head around what happens if the Trump administration loosens regulations on banks, but the Trump administration is also supposed to be good for crypto and private credit and all these different things. What does that mean for banks?
So I think when we talk about regulation and deregulation, we use those words and it brings to mind the analogy of a light switch in a building. In a room, we're on, off, the light is on, the light is off. In fact, all of these systems in the financial sector, whether it's private credit, whether it's banks, are highly, highly regulated systems. So I prefer to think not in terms of regulation, deregulation, but basically in looking at the efficiency of regulation. And that is what I think is happening or about to happen. Crypto is a completely different story, right? Because right now we don't really have a good regulatory framework for crypto. And the crypto sector itself has been begging for a good regulatory perimeter, right? They've been begging for a good framework. And we've been stuck in this world of, is it a commodity? Is it a security? Can we take this square peg and put it into this round hole? And yet in doing that, we haven't had investor or consumer protection.
But it's a competitor to banks, right?
Yeah, what if they let crypto as part of this regulatory framework? And it seems like, obviously, crypto really has President Trump's ear.
Right.
They've helped the industry,
Right.
funded a lot of winning candidates, right? So they've got some momentum. If they win the argument and are allowed to essentially hold your money like a deposit, if crypto companies can lend, do traditional banks kind of lose business to those guys, do you
So
think?
I don't think that crypto is 100% competitor of banks. We did have FTX, and they crashed and they went down. And did you notice there was no systemic impact on the banking sector?
On some banks there was, right? I
Just
think the
one.
Silvergates.
Right. And the question then that came was whether there were banks, and this was the case with both banks that failed, that they had a lot of deposits from crypto companies. But banks don't buy, sell, hold crypto. They can take deposits from crypto companies. They may, in the new environment, be able to custody if the SEC changes its an interpretation, and they may have services to crypto. But I kind of think we're going to have two ecosystems that end up living side by side in the same way that we have non-bank credit living side by side with banks, and in the same way that what we've seen in the private credit markets, it kind of starts out as a competitor to banks, but now they're in all of these partnerships. So it's a complex system where I think we're more going to be in an environment of frenemies than enemies.
But how do you think that today's, just call it, Republican Party maybe thinks about these issues, right? Because maybe you're tempted to think of, kind of a traditional framework in which, like, oh, Republicans must be friendly to banks, right? And given the sort of sometimes populist edge of some leaders today, you think of, J.D. Vance has, co-sponsored a bill that would basically, add additional burdens to the credit card industry, right? They're not necessarily friends to some of these big financial institutions, and so maybe there's a feeling that the way to go forward in finance is not to just like, oh, let's let banks do whatever they want, but instead to say, you know what, let's allow more people to compete with them. Let's let fintech companies do stuff that they've been prevented from doing and things like that. How much do you think that will play into the regulatory conversation in 2025?
There's a really, really interesting new coalition that has formed. And so the ingredients on the cooking pot on the stove and the stew are going to be quite different. The multicultural working class coalition that Trump has put together. So I'm from a small town in Michigan, and I like to call them Joe and Jill Lunchbox. And I kind of remember them from my high school class, right? And he works on the line and she works in retail. And I think they're going to care about overdraft fees. They're going to care about credit card fees.
Trump has proposed a cap on credit card interest rates. That would not be good for banks.
It wouldn't be good,
right?
And it's probably not.
I don't know if he'll go that route.
It's not going to go that route. But I think
you don't think so. You don't think
I don't think that cap will happen. But I think what he's responding.
Why do you say that?
Because it would just drive too many people out of the credit card sector. But I think that what he's saying is he knows that Joe and Jill care about that, and he knows they care about protection. Their son's in the Army. This is this is my teaching couple. They're not a real, not real people, but there are people like that, and I think there's a lot of fraud out there, and there's a lot of concerns of consumers by fraud. So I just think we're going to see a new mosaic. I think we're going to see a new mosaic, and on the consumer side, I think that there's still going to be a fair amount of caring about what Joe and Jill Lunchbox need in their lives.
So stepping back a little bit, how much does regulation matter as opposed to things like the economy for banks? Which one trumps the other?
Oh, that's a great question. I'm not sure there's a good answer. I want to think about it. Can I add something else in? I think there's regulation, there's supervision, and there is the economy.
What's the difference between regulation and supervision?
So the regulation is what's public, the Basel III endgame, the
rules.
Okay. But banks are also supervised. They're examined. There is this professional cadre of examiners who are chartered commissioned examiners who go in and examine banks and their loan books and the quality of their loan books and the quality of what the banks are doing, and that can have a huge impact on bank behavior.
So even without
bank lending.
changing the rules,
Even without
just
changing
you
the
can
public
have an impact.
rules,
Okay.
you can have an impact. I think all three of them, what's happening in the economy, what's happening in what I'll call regulatory change, because regulations that are set are just, they're, folks have adjusted to it, and then the intensity of supervision, all three of those are going to have an impact on the banking sector and what they do.
It's going to be a busy year. So we're going to take one last break. And then when we come back, we have one last question for Meg Tahyar. Okay, so we are really, really curious, especially after the Silicon Valley banking crisis. What is one thing that you think we should be paying attention to when it comes to the next potential banking crisis that's not on people's radars right now? What do you think could actually cause a really big potential banking crisis?
I'm so glad you asked that question. Can I answer it by saying what I think would prevent the next banking crisis
I guess
first?
that does imply what could cause
Okay,
it.
okay, go for it.
Okay, a positive spin on that question. I like it.
Deposit runs that are triggered by anything. I mean, we've got 800 years of history. They are triggered by many different things. But deposit runs and a lack of confidence is the last precipitating factor, whatever the causal trigger is.
And that's really what happened in March 2023.
That's what happened in
right?
March 2023. Here's the most important thing that I think should be on the agenda and isn't high enough, and that's deposit insurance reform. And that's going to take Congress. I think there are 2 or 3 very simple things that Congress could do that would prevent the kind of panicked run that we saw last time. They could raise the insurance limit, index it for inflation. They could raise it a lot for what I'll call operational accounts, for religious institutions, for charities, for small and medium-sized businesses. There's an amount that could be chosen that would make it so that next time we don't have this pulling out of deposits the way that we did. And I think we can get there without insuring all deposits all of the time.
Well, Meg, thank you for giving us a roadmap for 2025 and beyond. And thanks so much for joining us here.
It's been a great, really deep pleasure, and thank you so much.
Thank you, Meg.
Some of us with a little gray hair remember even going back to Basel I.
Basel I. Basel, of course, being the city in
Right.
Switzerland where they initially discussed these things.
Oh, I didn't know that. Okay.
Yeah. That's it. You can take a trip to Basel to discuss banking regulations.
Shall we do a field trip?